Hello and welcome back to the channel. This is the video playlist on business taxation, and I hope you enjoyed the small break which we had after the last video, but now it's going on. Here we see that we still have to do a mass of things. We are still at the beginning, so the best thing we can do is quickly begin. This is now video number 6, and after dealing with questions of personal tax liability, we should now deal with questions of the taxable income. This will be more than one little video because this is the main part of every corporation tax case. So let's just begin. As you have already heard, corporation tax is the income tax of juridical persons. So naturally, it's designed as a parallel to the income tax. And that means nothing else that the tax base should be the income, and that the rules which say what is income and what is not income should be nearly the same, or should be the same as in the income tax, as far as nothing else really requires a deviation, so a different solution. For us, that means income in the case of unlimited tax liability should just be determined in the same way as in paragraph 2, unlimited tax liability for natural persons, where you have 7 types of income and no restriction to inland. So the worldwide income catalog in paragraph 2 should also count for corporation tax. And in case of a limited tax liability, a corporation should be liable with the same things as a natural person. Basically, that should be the idea. And so we should be able to use the catalog of inland income in paragraph 49 ESTG. Now, naturally, this is what we think should be, but we need a legal basis for it. Accordingly, the text of the KSTG really confirms our suspicion how it should be done. Paragraph 7.1 says the tax base is the taxable income. Paragraph 7.2 says the taxable income is the income minus certain tax-free allowances, which are regulated in paragraphs 24 and 25. And by the way, the position in the Tax Act shows that these free allowances are only granted in special cases. Especially the free allowance of 24 KSTG is only granted to legal firms which cannot pass on their profits to other persons. So it would be possible for a private association for non-economic purposes. In Germany, that would be an eingetragener Verein, an EV. Yeah? But it would never be possible for a GmbH or AG or other capital companies or cooperatives or so. So no legal entity which serves economic purposes in the first rank or so. So nothing which could pass on profits, which serves as a capital investment for shareholders or so. And then what we really need, and that would be paragraph 8.1 KSTG, that allows us to compute the income as it would be computed in case of an income tax case. So here is our legal statement which says, yes, you are allowed to use the corresponding rules of the ESTG, that means paragraph 2 or paragraph 49, for a corporation in order to determine the taxable income. Because, as you perhaps already know, every tax act has to be read separately from everything else. So the world of the KSTG is in principle a closed world. Other laws have only to be read if the KSTG directs you to them, or like here says, okay, take over some results of other laws. Because the idea is that every law should be able to be read in itself and comprehensible in itself, apart from general basics, for example, some definitions which might be laid out in the general tax code, apart from such cases, usually one always tries to include all the necessary rules to apply a tax act within that tax act itself. So, these rules are applicable in all corporation tax cases under German law, naturally, and therefore they can always be cited as a nice general introduction to a case solution in cases where you have to deal with the events or so. So nearly everywhere where you have to work on a corporation tax case, these three rules are a nice introduction and always are adequate or even logically necessary. And before we go on, just to remind you of the fact that one can never deal with a taxation case without working with the law. Here again, the reference to the Tax Act, and naturally, here I work with my personal translation. You probably know that there is a link below where you can at least find one version. The first thing which naturally must be mentioned is the absolute disclaimer. This is a very personal translation which I always bring forward. It's only a rough one. You can't rely on details of the wording which I chose in a foreign language. That all is clear, but it's meant to convey the basic idea. So let's look for the KSTG and then hop over to KSTG. Go. Yeah, here's the KSTG translation. And now we have to go to paragraph 7. Yeah, and here we see what I mentioned before. The corporation tax base is determined according to the taxable income. Now, that doesn't really help us because we now need a definition what taxable income is. Taxable income is the income as defined in paragraph 1 KSTG, lowered by allowances in paragraphs 24 and 25. So let's hop over to 8.1 because the law referred to that, and 8.1 says now the decisive first sentence. Paragraph 8, section 1, sentence 1, this is, you see the first number here, sentence 1, what has to be regarded as income and how the income has to be computed is to be determined according to the rules of the Income Tax Act and of this Tax Act. Naturally, if there is a deviating rule, a special rule for a specific problem in the KSTG, which modifies the rule of ESTG, then naturally also the rules laid down in the KSTG must be taken into account, and naturally then they take prevalence over what is stated in the Income Tax Act, because you don't make a deviating rule or an additional rule in the KSTG if you want it to be ignored. That cannot be the wish of the legislator. Yeah, and while we are at it, we can also have a small and short look into paragraph 24, that strange thing which I mentioned before, that thing with the free allowances which were mentioned. Here you have paragraph 24, from the income of taxable juridical persons, a free allowance of 5,000 euro, but not more than the taxable income may be deducted. So that means if you have only a taxable income of 4,000, you end up with 0 and not with minus 10. But then the decisive thing is the second sentence. This rule does not apply to all institutions which can pay out dividends to shareholders as defined in paragraph 21, number 1 or 2 ESTG. So all institutions which can be created by investors in order to make profit, GmbH, AG, SE, and the foreign corresponding legal forms of them, can never profit from that free allowance here. The only institutions which remain are those who are normally not founded for economic purposes. So mainly an EV, a foundation, or other forms of that kind. Good. So as we have seen that, let's turn back to our contents and let's go back to what we have to talk about. So the logical conclusion is that if we have to deal with the corporation tax, in principle, all the 7 types of income are applicable for KSTG purposes too, but which one of them or some of them can, for practical reasons, not be fulfilled in case of a juridical person. So let's ask ourselves first if we still can remember these 7 different types of income. There was agriculture and forestry. There was business income. There was income from self-employment. And you must always remember that under the German tax understanding, self-employment is understood completely different from what English or Americans probably would suppose. Self-employed people, that's a category which in the German Income Tax Act is only applied to selective certain, let's say, noble professions, which were not regarded as, a plain business, but something better in the Middle Ages. So self-employed people are only lawyers, inventors, teachers. So all those people who were regarded as something better in the Middle Ages. The peculiarity is that these jobs, even today, are freed from the trade tax, which is levied by cities. Now, self-employment requires that the self-employed person does work on every individual job or order, himself or herself, and does only use the help of assistants, but still has a personal dominating impact on the outcome or the work done. It might be sufficient that you guide your assistants through simple cases, but you need to take a personal involvement in each individual case. Otherwise, the case as is worked on completely by employees would not be regarded as self-employment cases anymore. Income from employment was type of income number 4. Income from capital, income from lease and rent, and the so-called other income, which is not comprehensive, so all-covering rest or catch all the rest clause, but it's again a list of selected different rare things which can lead to other income. So you have first to check the first 6 types, and then you have to check under number 7 again another long list of additional things which could qualify as income too. But what is included in none of these lists is not taxable. Now, if we check that under the aspect of a juridical person can do it, well, agriculture and forestry, yes, a plain yes, a GmbH or a cooperative or so can own a forest or can own a farm, so that can be fulfilled. Business, yeah, naturally, a juridical person can naturally own a shop, run a factory or so on. In most cases, there are even created to do that, so business can be done. Self-employment, you remember, self-employed income requires that the taxpayer takes a personal involvement into or in the working on that job. And surprise, this is not possible. A juridical person has no brain, no hands, no feet, and nothing. So a juridical person needs always 100% of other people to work on a specific order. So a juridical person can never fulfill that basic requirement of the classification as self-employed, that basic requirement which says the taxpayer needs to take part, a guiding part, in the work on each individual job, because the taxpayer is the GmbH or AG, and I have never seen a GmbH, fictitious person, working on an individual case. They can only use the help of their managing directors, and that is, they don't do the thinking themselves. So self-employed income is not possible there due to a juridical person is not able to fulfill the conditions. Employment. No, you will never see a juridical person acting or entering into an employment contract, because due to the nature of employment contracts, that's only possible for natural persons. There are perhaps other areas of law where a juridical person can obtain a comparable position, but it's not possible at all to have juridical persons acting as an employee, really, and therefore there can be no income from employment. At least under normal circumstances. Yeah, I just wonder if it's possible that if I die and have a last claim to a wage, if I can pass that by way of inheritance to a juridical person or so. But ladies and gentlemen, that would be rather strange. So we can say that under normal circumstances, it will be absolutely impossible to have income from employment. The next thing, income from capital. Naturally, a GmbH or an EV, for example, can have money in a bank account, so they get interest, so they have income from employment. Or a private association, a chess club, might hold some shares where they have invested some money, and if the shares pay out some dividends, then they have income from capital. Yes, plain and simple, very easy. Income from lease and rent, yes, so why not? You have, let's say, a church, or you have a private association like a chess club or a gentleman's club, and so on. And it might be that somebody has sold them or donated them a house which they let for rent or so. Why not? So possible they can have income from lease and rent, and that would even be a good investment for them. Other income, here, ladies and gentlemen, we can only say it depends. For example, other income also covers the gain from selling a house within the 10 years period between acquisition and sale. That can be done by an EV. On the other hand, there is also something like a lifelong pension that's a bit difficult to be fulfilled by a legal person, or even remunerations for being a member of parliament. Seems to be pretty impossible to elect a juridical person into parliament. So some things there are possible, others are not. Good. Some things should be clearly noted by you. Notice please clearly that 8.1 only says that the rules on the determination of the income are taken over to the KSDG. You know that with legal stuff you always have to read what can be read there, and you always have to read what is not written there too. What is not written there is that also the tax tariff is taken over. No, the rates are not taken over. The determination of the income is mentioned, but not the determination of the tax tariff. So the rate is done differently, completely differently in corporation tax than in income tax. For example, in corporation tax, you have no progressive tariff. You have one single rate which always applies, irrespective of how high or low the income will be. We can see that in paragraph 23 KSTG, and well, if we see paragraph 23, section 1 KSTG, yeah, we should really do this. So let's have a small break and change to the Tax Act and look up what 23.1 really says. And here you see it. It is very, very simple. The corporation tax is always 15% of the taxable income. So no progression, no brackets with different tariff zones, all these complicated things which you know from the income tax tariff are completely neglected. They don't exist in the field of corporation tax. Here, everything is just a proportional 15% of whatever the taxable income might be. So, if the tax rates from the income tax tariff or income tax act do not count for corporation tax purposes, that naturally also means that 25% special separate taxation of income from capital does not apply here because, well, the 25% is a rule on the income tax rate, and it's not a corporation tax rate. Furthermore, the rules about the withholding tax, the capital income tax of 25%, which is usually levied by the person who pays out dividends or interest in Germany, that this tax is already definitive and is not paid back or refunded or credited to your tax burden. That rule also does not apply in the field of corporation tax, because here paragraph 43 section 5 ESTG says that the income tax is definitely dealt with if the capital income tax of Germany has been withheld correctly. But here we have to do with corporation tax. So a rule which says capital income tax is enough for income tax purposes, that rule does not mention corporation tax. And so, ladies and gentlemen, clear effect. For corporation tax, the capital income tax which was withheld on a dividend or on interest is just regarded as a prepayment to the recipient's personal corporation tax. So if 25% were prepaid, which is the usual amount for capital income tax, then 25% will be fully credited as a prepayment made to the person's personal income tax, and personal corporation tax. So there will be, in all probability, a refund of at least 10% at the end of the year when a tax declaration is handed in. So a good reason why, in all probability, you will never catch a GmbH or AG trying to commit tax fraud with regard to such income. So remember, the taxation with a 25% flat rate on income from capital does not apply in the field of corporation tax. We learned that from properly reading the text. Note further, the free allowance, which is mentioned in paragraph 24, which we have already seen, does only apply to legal forms which can never pay out dividends. So it does not depend on if they pay out dividends this year or not. It is the question if they can never pay out dividends due to their legal form. And that is only registered private associations like a chess club, EV, or a foundation or something like that, in certain circumstances can qualify for that. But for a GmbH, an SE, a cooperative, and other legal forms, you can definitively forget this free allowance, it is forbidden in such cases. So we have already looked on that. 24, 5,000 euro were granted as a free allowance under that rule. Here you see it again, 5,000 only. And the reason why these 5,000 are granted for institutions like an EV or so are, by the way, just because an EV or similar legal forms are not founded to make profit. And if they make a profit, that probably happens by coincidence or by chance. And if you have members or presidents or so staff of an EV, they are probably not familiar with legal rules or not familiar with tax rules. So it might happen that they forget to hand in a tax declaration. And the idea is, well, you can simplify the lives of the fiscal administration, simplify the lives of these people and of everybody if you just say, okay, if they only make a very small profit, we can legally forget that. And in order to make that possible for these institutions who do not aim at profit, up to 5,000 euro a year are declared tax-free. So if they earn 5,100, they would only have to pay taxes on the 100. And if they own only 4,000, then it would be no punishable offense if they don't hand in a tax declaration and know nothing about corporation tax, because under that circumstances they would have no taxable income, and who has to pay no tax cannot commit tax fraud. And that's the main purpose of the rule. You want to keep out the responsible persons out of prison if only a small amount is in play. Whereas in case of a GmbH or AG or SE or other enterprise legal forms, naturally there you're running for profit, and you must know there is a tax law, and you must know you need an accounting, and you must know you will have to pay taxes and to hand in tax declarations. There, nobody can pretend I didn't know there is something like taxes. And so that tolerance here with the 5,000 euro rule is only shown with regard to such institutions as a chess club or a sports club or similar institutions which not primarily aim at, or should not primarily aim at profit. So that's the explanation. You've seen it again, and my recommendation is, if you deal with an EV, think of it. If not, forget about it. This is only relevant if, for example, later friends of you who find out that you studied taxation want you to deal with their tax declarations in Germany for such a private association, or if they become nervous because they hear something about corporation tax and its existence, then you can probably comfort them by saying, okay, if it's only 1,000 euro which you earn per year, then forget about it. It is legally allowed not to pay taxes. Yeah, we just heard about the purpose of such an allowance already. We want to keep some people out of prison who do not deserve that if by chance an EV made a small profit of 200 euros, so during a year. The additional allowance of per of 25 KSTG is only for very rare cases and will probably never play a role in your whole life. So that's the reason why I did not even translate it. Good. Now let's go a bit more into details. Think about a case, because naturally general knowledge on taxation does not really help if we are not able to deal with cases, and that is what you will always have to do in exams or in the real world. Apply your knowledge, not only have it. So the Friends of Chess EV is an EV, so a registered private association with non-economic aims, and what they do is clear from the title. It has its statutory seat, so its official registered address, and its place of management in Kleve in Germany. It has been founded in 1863. You see from the asterisk, that is always if I, without any motive, just invent something because I need a nice detail. So don't worry, why is it 1863? Answer, well, it sounded well. And it has members from all over the world. So our task will be, how high is the taxable income of this EV? And sometimes an EV can apply for a status of a tax-free charity organization under paragraph 5.1 number 9 KSTG. But let's agree on one common assumption. This EV does not qualify for a tax-free status. It does not qualify as a charity organization, because otherwise, if it were tax-free, then the whole affair would be uninteresting. Good. Now, let's begin. The first thing which happened is, already since the year 1875, the EV has owned a house in Kleve, from which it gets rental income, 36,000 euro this year, and the rent payment for December was due to a bank error, first transferred to a wrong bank account, and after the EV asked the bank what's happened, the EV, the mistake was corrected, and then the EV received the money, but they only received that money now on the 20th of January of the following year. That was the year 02 in the present case. So what can we do now? We can, I believe, already start with a case solution, because we have already some basic information where we can begin writing a solution. So let's think about doing just that. Now, let us simply begin with the probably oldest rule which we have in life. Let's begin with the beginning. And the beginning would be personal tax liability. And there, ladies and gentlemen, the EV is a juridical person. So KSTG applies. That is something which we directly can say. And now we would have to look up if it's covered by the catalog of those things which are subjected to unlimited tax liability. So we probably take a look into paragraph 1.1 KSTG. And so let's do exactly this. And 1.1 KSTG, okay, now let's look. Companies, no. Cooperatives, no. Insurance, no. But other juridical persons, yes. Established under private law, yes. That means our EV is 1.1 number 4. But nevertheless, we still have to check, are the requirements also fulfilled? Yes, the place of management or statutory seat is in the inland. One of both is sufficient. We have even both in the inland, so indeed unlimited tax liability will be the case here, and so we can sum that up and just register that in our case solution. So unlimited tax liability according to paragraph 1.1 number 4 KSTG, because seat plus place of management in the inland, namely Kleve, sorry, capital K. Okay, that was already the personal tax liability issue, and now analyzing the events, so the so-called objective tax liability, the tax liability of the objects. Yeah, let's begin with the first event, which we have here. Letting the house to tenants. You remember probably from the general introduction to tax law lecture that my recommendation was ask 3 questions, one after another. First, which type of income is it? And here we probably suspect this could be income from lease and rent. But now, naturally, we are not sure if that really is the case. At least we should not be, because if you deal with legal stuff, you always check everything if it really is true. And so we will go to the Income Tax Act and check it. But I have just violated one of my own recommendations. And so before we do that, we remember that there was a kind of a general introduction. We have not yet got the permission from the Tax Act to look into the Income Tax Act. So what about that general introduction? The tax base is the income, paragraph 71 KSTG. Or better, the taxable income and it's to be determined according to ESTG and KSTG rules. See paragraph 1.8 KSTG. We have already looked into these, so I trust you that you can remember that. But now we can go on with our first case solution here. And in order to be sure that it's income from lease and rent, we should take a look into the Tax Act. And income from lease and rent, ladies and gentlemen, is probably paragraph 21. So let's have a look to paragraph 21. So now go to the Income Tax Act, contents, paragraph 21. Come. And here it is, paragraph 21, section 1, sentence 1. Income from lease and rent consists of, now number 1, income from letting for rent immovable property, especially land, buildings, parts of buildings, ships which are registered in a ship's register, and of rights to which the rules of the German Civil Code, the BGB, on immovable property are applied. Yes, ladies and gentlemen, that's clearly our case, so we can apply it. So, paragraph 21, 1, number 1, ESTG, that was our reference which we needed. Now, the second question, which I always recommended you to look for, was what is the tax base? There are 2 tax bases in the ESTG. Tax base is either the profit or the surplus of revenue over expense. And the difference was the surplus does not include the gains from selling the property which you use, but only the current revenue and current expense. So tax base for lease and rent was, oh my God, was it the profit or was it the surplus? Let's look it up again. Perhaps you have forgotten it in the meantime. And so we just remember that was something in paragraph 2 ESTG. After the list of the 7 types of income, you got the information which tax base is needed for which type of income. So let's have a look again. So here is paragraph 2 now to be seen, and we need paragraph 2, section 2. The income is defined in case of agriculture and forestry business income and income from self-employment as the profit, and in case of all other types of income as surplus of revenue over income related expense. That is our case here, and so we can take home to our case solution that we need the surplus of revenue minus expense, and the reference will be paragraph 2, section 2, number 2. So that already brings us another additional point, ladies and gentlemen, which we naturally note down. So tax base is the surplus of revenue over expense or income related expense to number 2 ESTG. By the way, in cases like these, you should always add the abbreviation for the tax act in play, or which is involved, because naturally we have here always to jump to and back between two different laws or tax acts, namely ESTG and KSTG, so you always need to give the concrete reference. Now, a last question which we usually have to ask is, when do the different parts of the income become relevant for taxation? So the point of time. Sorry. Well, the basic rule under paragraph 11.1 ESTG was that income is received when it's relevant for that year during it is received. So when the payments are received, 3,000 are only received next year here. And there was a rule that regularly made payments are still attributed to the year to which they economically belong if they arrive only a short time after the end of the year, or if they are paid only a short time before the year to which they belong begins. This rule is by jurisdiction made concrete and interpreted as a 10 days delay rule. And this short time rule does not apply here, because the 20th of January is 20 days after the end of year 01. So the consequence is of the 36,000, which is given as income, so already as net amount, which we need, 3,000 only become relevant next year. Conclusion: income for this year 33,000. Okay. Yeah. Then we have answered all the three basic questions for event number 1. So we have to look for the second event. And so let's go to the slide again and have a look what the second event can be. And here the second activity which our EV undertakes is that a former member who emigrated to the Principality of Monaco had left 2 office buildings in Monaco to the club already 5 years ago. The annual income from these 2 buildings is 174,000 euro, and the monthly rent payments were always punctually paid on the first day of each month. So, that helps us greatly, and so that is something which we are going to work on now. So, the house this in Monaco. Here we have again income from lease and rent, paragraph 21, subsection 1, number 1 ESTG. And that the houses are not in the inland does not matter. Worldwide income taxation. Huh? Good. That in brackets is not perfectly necessary, but if it comes to our mind and we want to say it, why not? Because it's true. Tax base is again the surplus. Paragraph 2 to number 2 ESTG. Here is the income already given, and we don't have to make any modifications under paragraph 11 because not necessary. We don't have any deviating points of times of payment or so. So everything belongs to year 01 according to paragraph 11 ESTG. As we thought about it, we could also make a note and write on that. Now let's look to the case again, and we have now a third event which happens at the end of the year. The EV sold the 2 houses in Monaco. The first house, which the previous owner bought 8 years ago, bought a gain of 300,000. The second one, which the previous owner had already bought 15 years ago, even led to a gain from selling it of 1.5 million. Now you should know that under the German law, handing over private property like a house without selling it, so as a gift to somebody else, is not seen as sale and acquisition, but then it's just seen as if the previous owner had gone on with owning it. So if you look to the 10 years possession period, which decides over taxability of selling a private house or not, then these 10 years are measured from the time when, for the last time, somebody bought the house for money. That means that in the first case here, the house is bought within 8 years after acquisition, sold within 8 years after acquisition, whereas in the second case, the 10 years period has already expired. So the one sale will be taxable, the other one will be not. That leads to number 3, selling the houses in Monaco. Selling the first house is taxable other income because it is sold within 10 years after acquisition. The other house is not. C. Paragraph 23 ESTG, and for this, ladies and gentlemen, naturally we will have to check that. Yeah, here we have it. 23.1, the taxable sale, or with a high-level word, alienation of private property. That is the alienation of real estate and rights which underlie the rules of civil law on real estates. If the time between acquisition and alienation does not exceed 10 years, that's our case here. Buildings and so on are to be included as far as they have been erected, extended, or enlarged during this period. That applies accordingly for parts of building, blah, blah. Exempt are assets which have been during the time between acquisition or finishment and or completion and alienation exclusively used for own housing purposes or have been used for own housing purposes during the last 2 years before the alienation. Okay, sounds great. And 22, number 2, was also a nice idea. Here we have the other reference why the selling of private property can be taxable, and so seems to be okay. these are the two references which we need. Yeah. So this will be 23.1 ESTG in combination with paragraph 22 number 2 ESTG. And so tax base is officially surplus, but here the gain, and that's given with 300,000 euro. Now we could even look up where we find the rule that in case of the alienation of private property, naturally the gain is the tax base or is regarded as the surplus in this case. So, well, look it up. Indeed, we find the source which we need, how the taxable income has to be defined here in paragraph 23, section 3 ESTG, that the gain or loss from the alienation as defined by paragraph 1 or as meant by paragraph 1 is the difference between the price which you obtain on the one hand and the cost of acquisition and manufacturing and the cost of the sale on the other hand. So that helps us. Here we have an additional reference to the Tax Act, which makes us certain that we're really doing the right thing. So see paragraph 23, 3 ESTG. Now, third event has been dealt with. So that means let's look if there is a fourth event. And indeed, a fourth event shows up. The club has sold the right to use the brand Friends of Chess to a t-shirt firm which pays them a license fee of 12,000 annually. So it's probably a wrong usage of the word sold, because they didn't sell the right, they just rented out the right, or they let it for rent to be precisely. So they kept the right, they didn't sell it. It was a kind of lease contract here. The brand Friends of Chess was led to a t-shirt firm which pays them a license fee of 12,000 annually, and the license fee for the year 01 was transferred to the bank account of the EV already on the 3rd of January 02. This is now what we have to deal with. Nothing very special. Let's just begin again. So, event number 4. Letting the brand name for rent. This is probably income from lease and rent. And we will have to confirm that later, probably paragraph 21.1. And, okay, why should we postpone it to the future? Let's just have a look into that damn Tax Act again. If income from letting a right for rent is also a part of lease and rent income type. Okay, let's have a look. Yeah, and here we have paragraph 21.1. Number 3, income from transferring rights, especially for a limited period of time. So not selling them definitively, but collecting a kind of a rent payment or lease payment for it. Yes, we were absolutely right. That's income from lease and rent under the German Income Tax Act 2. So we use that. Now, that was number 3, ESTG. Tax base is the surplus. See again, paragraph 2 to number 2 ASTG. Here, given as 12,000 euro, all relates to this here. See paragraph 11.1. That's probably the 10 days rule, which we naturally have to look up again. Which sentence in 11.1 tells us this? And here it is, 11.1. Revenue is to be attributed to the year when the taxpayer receives it. Payments which have to be made in regular periods of time are to be attributed to that year to which they economically belong if the payment is made shortly before or after the end of the calendar year. So sentence 2 would be the sentence to which we have to relate. So that's this one here. And now the best possibility is to go to the next slide. Yeah. Now we have, ladies and gentlemen, just to finish the case. So probably entry number 3, adding it all up to the taxable income. That would be here from event number 1. We had 33,000 euro. From event number 2, we had 174,000 euro. That was given. From event number 3, we had a taxable amount of 300,000 only. And now we have from event number 4, 12,000. If we add that all up, we end up with, okay, now I need a short look to a calculator. I believe it's 519,000. Now, minus the free allowance of minus 15,000 under 24 KSDG, because it is an EV and EVs cannot pay dividends. So the final tax base is 550,000 euro. And we can now even look a bit into the future. Tax rate and tax, well, paragraph 23 KSDG said it's 15% of that. So 15% of 415,000, and what comes out here is 77,100 euro. That is the corporation tax for this chess club EV, which is, as you see, evidently enormously wealthy, has probably very important members all over the world, probably rich ones. So that was this case, and we arrived well at an end here. Then please permit me a last remark. Naturally, if you have such an EV here at Chess Club, then you can also assume that all these wealthy and rich members of the Chess Club have to make contributions to the Chess Club regularly, so that they have to pay membership fees. At least that's the case with many private associations. And this raises exactly that question: what about the membership fees? In case of a GmbH or AG, we are sure that a contribution of a shareholder is not income, because when you have an enterprise, a contribution is not income, it's just a contribution. The definition of profit in the ESDG was the profit is the increase of property corrected by contributions and withdrawals. So contributions don't count. How are we going to see membership fees of a private association? And the answer is the membership fees usually do not fulfill any of the 7 types of income. And in order to be on the safe side, that is clarified in 8.5 KSDG, membership fees which only are paid because one is a member do not count as income of the institution in question. That would be different if you pay or become member only because you want to get services from the association. So especially if the membership fees are determined according to how much you use the services of that association, it would no longer be a pure membership fee. But membership fees, no income. So if our EV also obtained from its members membership fees of 500,000, the result of our previous case would not change. We would just have to add an additional remark that the membership fees are not taxable income under 8.5 KSDG, naturally. Okay, so this, I think, was enough for today. I thank you very much for watching this video, and I hope you enjoyed or survived just seeing how a case should be solved here under KSDG. Now, in the next video, we will learn some additional rules which apply for GmbHs, AGs, and so, which sometimes simplify and sometimes complicate our lives. Okay, just to say it again, thanks for watching. Hope to see you again soon. And that's it for today. Goodbye.